Starting with a new chapter called risk analysis and capital budgeting. Let us see that, say, first of all, from examination point of view, what kind of importance it has been given to it in CA intermediate syllabus. Dear students, like May 2018 till January 2021, I have provided the reference of the questions which have been asked from this chapter. In May 18, it was not asked. Then 5 marks, 11 marks, 5, 5, 5. So we can say that on an average it is asked for 5 marks in examination. Exceptionally, May 19 it was asked for 11 marks. And friends, whenever a question is asked for 5 marks, then always understand that, say, it is a question from the compulsory segment. That is what's the kind of importance that it has. Let us have an understanding that, say, what are the learning points that, say, we have in this chapter. Okay. To explain that, say, take a few examples like this. Friends, what happens that, say, when we do the capital budgeting chapter, then in that case, let us say we are making calculation of NPV. Now NPV is calculated by taking into account the forecasted values in terms of the selling price, in terms of the direct material, direct wages, overhead, sales units, method of depreciation, life of the project, expected salvage value, investment, and so on. Now all these things, that say whatever forecasting that we make, we know that the things can be different than what we anticipate. In terms of the revenue and in terms of the expenses, the things can be different also. Obviously we understand, if at all the revenue increases, then in that case the management would always be happy. If at all the expenses reduces, again the management is happy, there is no issue. However, if at all there is a situation which is reverse, that the revenue is falling down than what we had anticipated, sales is less than what we anticipated, or the expenses are more than what we anticipated, then in that case the management is bothered, management is worried that, say, why did we take this project? So basically this is the chapter in which we are conveying to the management that the things can be different than what we anticipate. And this is what, say, we understand is a kind of risk which is there in the capital budgeting, and we are going to analyze the same. This analysis which we are going to make, for that, say, there are certain techniques which have been developed in the financial management. So those techniques are like this. The first is given a name as probability distribution method of NPV calculation. Now what is the probability distribution method? It is something like this. Listen carefully. Suppose there is a company which is considering manufacturing and selling of mobile phone in the market. Taking into account, so the situation right now which is prevailing in the market, the company is considering that, say, if at all we introduce this kind of new telephone, new mobile phone in the market with these unique features, then in that case we will be able to capture the market. Let us assume that, so the market of mobile phone is 1 lakh number of units. Now in the very first year, what will happen? We understand that, say, we may be able to capture 10% of the market, or 15% of the market, or 20% of the market. It means that, say, we will be able to produce and sell 10,000 units, 15,000 units, or 20,000 number of units. This is the number of units that we are expecting to produce and sell. If at all the product is like the successful, if it is moderate, and if it is unsuccessful, in a way that, say, you are having, say, a kind of forecasting of more than one outcome, and you assign the probability for the each outcome. There are 60% chances I'm expecting that the product would be successful. There are 30% chances I'm expecting it to be moderate, and there are 10% chances that it would be unsuccessful. So this is the way, so we can have a kind of probability distribution method to be applied for the purpose of forecasting, and based on that, so we make the computation of NPV. That is the first thing, that is the probability distribution method for NPV calculation. The next is the variance and the standard deviation calculation. Now, friends, in the statistics, they have developed certain techniques with which we will be able to have say a kind of analysis, and for that say they have provided a kind of analysis like this. They have made say the number of research, they have made number of experiments before which they have come to this kind of conclusion. So there is a kind of bell-shaped curve diagram of the normal probability distribution method. Whatever the expert, that is the mean value that we compute, has 50% probability. Now, actual the things may be different than what we anticipate, and what is the rate at which it can be different is measured by way of standard deviation. Deviation. So the word deviation is indicating that to what extent the mean value can deviate. That is what we understand is the standard deviation. Standard deviation. So it indicates that actual result may deviate from the mean value with what amount is what we understand is called standard deviation. So deviation from the mean value or dispersion or variation, that is what you will be able to measure, and that is what one of the technique of say the measuring the risk. I do not know that say whether you have heard about the portfolio management or stock market or like the mutual fund investment to some extent. Then dear students, over there also you are having say the measurement of the risk say via say this kind of say the statistic technique say which can be used. So even like when you see the any electronic media for the news, then in that case this kind of so the reporting is made. So the variance, standard deviation, again we are going to use it for the purpose of project analysis. Then CV, coefficient of variation, that is indicating that say what is the risk that you have for every 1 unit of return. Then NPV using risk adjusted discounting rate, means whenever a project is having more risk, then in that case you apply more discounting factor, higher discounting factor for the purpose of NPV calculation. That is given a technical name as a risk adjusted discounting rate. So for the purpose of incorporating the higher risk in the project analysis, you apply higher discounting rate that indicates that say you require more return. Then certainty equivalent method, again it is a method of incorporating the risk in capital budgeting method. How to do that? So that we need to understand with the numericals. Then very importantly, sensitivity analysis, scenario analysis. This is what we have. Friends, as far as the simulation analysis and decision tree analysis is concerned, they have been eliminated from the syllabus. So these are not the the concept that say we are going to understand now. And lastly, we are going to understand say certain theory points. So this is what say we have in the very simple chapter of the risk analysis. I tell you friends that say this is a very small chapter, and at the same time say this is going to be say important from examination point of view, with the reason that mostly the compulsory question is asked so from this chapter. So first of all, write down a small note in that write down learning point of the chapter. In the written first point, in normal capital budgeting, comma, we assume that all projected values will be as it is and we take decision. Full stop. However, there is a possibility that actually values will be different, and it may change unfavorably. Full stop. Second point, in this chapter, we are going to understand different techniques for capital budgeting, risk analysis. Full stop. With this, we will inform management about important factors before undertaking the project. This is what we understand. Dear students, we are starting with the very initial basic questions wherein we are going to understand application of the probability distribution method. Let us start with the numericals. With that, so we will have more idea. So starting with the question like this, possible net cash flows of the project A and project B and their probabilities are given as below. Discounting rate cost of capital is 10% for both the projects. Initial investment is rupees 10,000. Calculate expected NPV for each project and you are required to give answer that say which project is preferable. Life of the project is only 1 year. For project A, we have been provided with the cash flows along with the probability. For project B, cash flows are given along with the probability. So now friends, what will happen? We can make the computation of the NPV of the project like this. First of all, we will compute the expected cash flow of the project at the end of the first year, and then we'll make the computation of the NPV of the project. Let me explain you that's how to do answer. In case of the project A, everybody is requested to pay attention. Working note number 1, calculation of expected cash flow at the end of year 1. In that case, probability cash flow to which x variable is assigned, probability into x. So what will happen? There are 10% chances cash inflow is 8,000. There are 20% chances cash inflow is 10,000. And there are 70% chances cash inflow is 12,000. So the expected cash flow and mean cash flow will be calculated. It's very simple, friends. There are 10% chances that you will get 8,000. So it is 800. Then there are 20% chances that you will get 10,000. So it is 2,000. And there are 70% chances that you will get 12,000. So it comes to 8,400. And the total of all of them is considered to be the expected cash flow. That is over here, 800 plus 2,000 plus 8,400. That comes to 11,200. This is what we understand is the expected cash flow at the end of the first year, and this is what we understand is called X bar, that is mean. Now, calculation of NPV. In that first year end, expected cash flow is 11,200, discounting at the rate of 10%. So 1 divided by 1.10. First year factor is 0.9091. Based on that, say you compute the present value. 11,200 into 0.9091. So 10,181.92. This is the present value of the cash inflow. Less investment. Amount of investment is 10,000. And difference of that is NPV. Amount of NPV is 181.92. This is the way the NPV for project A can be calculated. Please write down answer for project A and then try to do answer for project B on your own. Now after completing the answer for A, we can do it for B. So for project B, it will be again working like this. Working note number 1, calculation of expected cash flow for year 1. In that case, probability cash flow, let us assign y variable to it, probability into y. So 10, 15 and 20, 10, 15 and 75. Okay. Here is the probability provided to us and this is the cash flow. 4, 20 and 16. 4, 20 and 16. So we understand 10% chances it will be 4,000. So it is 400. 15% chances it will be 20,000. So it will be 3,000. 75% chances it will be 16,000. So it will be 12,000. 400 plus 3,000 plus 12,000. 15,400. This is end of year 1. Now calculation of NPV. Again, first year end 15,400 cash flow, discounting at the rate of 10%, 1 divided by 1.10, 0.9091, present value cash flow, that comes to 14,000.14. This is the present value of cash inflow. From that, investment is deducted 10,000 and we find NPV. NPV of the project is 4,000.14. This is the way the NPV is found, and then finally we have to take a decision. Project A and project B, NPV for both of them is positive. However, if at all we have to select one of them, then the project which is having higher positive NPV would be selected. So the project B which has higher positive NPV will be selected. So the right answer, the company is advised to accept project B. Now friends, over here, the way we have done the working is given a technical name as expected cash flow method. Now this answer can also be done with an alternative method, that is called expected NPV method. I just explained to you how you can do it. So there is an alternative method. In examination you can do either of the method. For project A we will be doing alternative method. Friends, there are three possibilities: 10%, 20 and 70. So the first 10% probability, what will happen? Year 1 cash inflow will be an amount of 8,000. So year 1 cash inflow is 8,000. It will be discounted in present value term at 10%. 0.9091. Present value 8,000 into 0.9091. 7272.8. This is the present value of the cash inflow, 7272.8 minus investment, that is 10,000, and difference of both of them is NPV, and the NPV of the project is 2727.20. So like that, so the first 10% chances, then next 20% chances, and next 70% chances. For the three different possible situations, we will compute NPV. Once you make the computation of the NPV, then you will compute the mean NPV. So similarly, for this 20% probability, we will make the calculation of NPV. And for the last one also, we will make calculation of NPV. Then mean NPV will be calculated for the project. This is an alternative method. So I request all of you to write down the alternative method, please. Friends, this alternative method is quite lengthy. However, just this is an introduction or the new question. So I request all of you to write this method. Again, year 1 cash flow, present value factor at 10% and present value. This is 10,000. One divided by 1.1, so that comes to 0.9091. So 9091, present value of the cash inflow 9091, amount of investment is 10,000, and based on that NPV is calculated. It is 909. Similarly for the last one, 0.70. Probability 0.70. Year 1 cash flow is 12,000. Discounting at the rate of 10%. 0.9091. Present value 10,909.2. Amount of investment 10,000. NPV is 909.2. Okay. So this is the way 3 times NPV will be found, and then you will have expected NPV. Column number 1 is probability. Column number 2 is NPV, to which X variable is assigned. Probability into X. Okay. So 10%, 20% and 70%. The NPV is 909.20. Over here it is 909 negative. And over here 2727.20 negative. So probability into NPV 272.72 negative. Next 0.2 into 909. So it is 181.8 cost, that is negative once again. Point 7 into 909.2, that is 636.44. $272.72 negative, 181.8 negative, 636.44 positive. So the expected NPV is 181.92, and definitely friends this answer will match with the answer that say we already have found over here. Over here exactly it is matching, but sometimes it may happen that it will have the marginal difference. But doing answer by either of the method is acceptable, and it will always give you the same answer. So we understand friends that we can compute the answer of the NPV by either of the method. Either you can compute the expected cash flows and then you discount the cash flows into the present value term for the purpose of NPV calculation. Or otherwise, what we can do, for the individual situation, you compute the NPV, and taking NPV as X, we can make the computation of the expected NPV. This is a way so we can have the NPV answer to be calculated by either of the method, and of course the first method is less time consuming, so preferably we will go with the first method, that is expected cash flow method.